Who do you think you are? I am back. That's what I'm here to say, folks. We got something fresh every time we come back. Oh, look at this. I left a little thing here. What are we talking about today? Again, like I mentioned before, we're kind of relegated to talking about the basics now, folks. We can talk about general information. I'd love to. So a great comment here from a Ran G over here. Great fella. I mean, come on now. Thanks for the comment. Appreciate it. We're going to talk about bond basics. What's going on in the bond market? How do we figure this out? Especially a time of market turmoil like this, a lot of people do turn to bonds. So it's definitely something to take a look at. And we'll certainly take a look at this today. And I've kind of got 6 main touch points that I'd like to talk about for bond basics. And anything more in depth, I'd love to go into as well. If you're interested in a topic like this, I know a good bit about these bad boys, so I'd love to go into more if you're interested. But 6 basic topics we'd love to go into. First one is actually a pretty simple one. We're getting right cracked in. I know this off-green background. It's beautiful, in my opinion. I hope you enjoy it as well. So first one. What are bonds? You think about it when you talk about investments and you talk about bonds, it's a question of what exactly are bonds? Well, bonds are basically debt instruments that are issued by companies. So, and it could be both by companies, could be by municipalities, and it could even be by the government. So obviously the Treasury, there are such things as bonds from the Treasury as well. So typically it's going to be a source of financing for a company. They want funds, so what do? They basically give you a note that says, listen, we'll pay you back in time, but for now we want your money so we can use it for other things. Could be any reason why companies would issue bonds. So, but typically it will be to achieve financing. For some reason, it might be a project they're working on, or just in general, just steady flow of funds into the company. So that's what bonds are really. There's nothing really a surprise there. It's not a shocker. They're just debt. Okay, it's just debt instruments, folks. Companies and or governments want to achieve some financing. So what do? We give them money. They pay us back in the long run. That's kind of what would happen, and we get paid interest in the meantime. So why would you ever invest in bonds? Well, the main reason you invest in bonds, for the most part, will be to achieve interest. Now there are other circumstances, and I can definitely go into those, and probably another video about specific types. Stuff like zero coupon bonds, in which you don't really earn actual interest on it, but you accrue phantom interest. A little bit different story, but for the most part, you invest in bonds because you want consistent interest payments that'll earn you a set yield. You don't really want to have to worry about the worry of the fluctuation of the market. And with that kind of leads me into the second point of how bonds are priced. And I have a couple examples here which I'd like to bring up. And you can get this pretty well every website has a bond ladder that you can look at, right? Really here I just have Charles Schwab listed up here, brokerage I use currently. And let's just take a look here. Given this bond ladder, we can take a peek. There's this corporates category here, as I have highlighted, AAA. We'll get into the ratings in just a minute. We're just going to talk about the pricing for now. But you see, bonds, they are kind of divvied out into specific time frames. So we can have upwards of, as low as 3 months on these bonds and as high as 30 years. Some companies, what is that? Some companies will issue bonds for. Let's just look at this 1 year chart of AAA corporate bonds. Let's just take a peek here and see what all is listed on there. So a couple things to note here. When you look at the price, you're kind of wondering, what in the world does this mean? So as I have highlighted here, it's gonna be price, and you're wondering, well, what the crap does that mean? 95.8140. What does that mean? I don't know. Is it $95? Well, look, folks, it's not. So these are going to be valued in bond points. So when you're actually looking at the total value here, you're going to want to multiply this number by 10. So just think of it in a sense that it's just because they do it in points, so it's a little bit different. But multiply this by 10, and you'll get the actual value. So bonds at par will typically, 99.99% of the time, be valued at $1,000. for a bond. In this case, this one is trading at a discount, right? So you see this one trading at 95.8, which actually represents $958.14 there at the end. So you can tell based off this price, it's trading a little bit cheaper than what it would be typically when it was issued. So, and there's a lot of reasons for that. We'll definitely get into what impacts the bond pricing as well. I think that's my next real segment here is look at that. No, the ratings are next, but that's okay. We'll definitely do that. What changes bond price? That's the fourth one. We'll get right into that. No worries. So, but yeah, that's how you price a bond. Basically, you see this. Just multiply that number by 10, folks. If we're talking about corporate bonds, a little bit different when we talk about our municipal bonds and how those are actually charted out in price. But we'll get into that at a later date. For now, we're looking at these corporate bonds. So you can see here, trading a little bit cheap. This one as well, this Microsoft one also looks like it's trading cheap at $992.45. So a little bit cheaper than your normal par value. Those are referred to as discounts. Now, let's take a peek here really quickly, see if I can find one that is trading at a premium, which I'm sure we might be able to find here if I go down to these A's. I could probably find one, and look, the first one listed here by Citigroup, a 5.5% here, showing a price of 100.62. So basically, that is trading at a premium, as we would call it, because it's more than that par value of $1,000. So this would be $1,006.20 would be the value of this bond. Now, what do you have in it? What's the point of investing in these bonds, as I mentioned before? Basically, it is a time deposit in this company that they will return the funds back to you whenever you do it. Now, they will always, let's just be clear here, they're not going to refund or give you back what you put in as far as like buying this discount bond at 95.34, right? $953. They're not going to give you $953 because when this bond was issued, it's worth $1,000. So the secondary market, which is just me and you trading between each other, just us normal investors, that's what fluctuates this pricing. Whenever the company issued the debt, it was all trading at 1,000, right, at that par value. But other market factors, me and you, the supply and demand, is what altered this to be either a premium or a discount. So if you buy it at a premium, you're only going to get that $1,000 par value whenever this bond matures. So technically, you'll lose a little bit in terms of what you invested, but the main benefit there is going to be the interest you earn in the meantime, which is going to be my next point here. So typically when you talk about pricing bonds, there's a couple different ways you can do it. You can do it based off the coupon rate, but most typically you'll look at the yield until maturity. That's going to be the main thing we look at for these. Now, a coupon rate is just referring to how much you're getting paid in interest in a year. So if we look at this Citigroup one, which is a 5.5% coupon rate, normally you'll get semi-annual interest, which means twice a year you get paid interest on these. So in a full year, you would earn that 5.5% of the $1,000 par value. So what does that equate to? $55 in a year. So just do that math out real quick. Every year in interest, you earn $55 on this specific bond here, this Citigroup one as we listed. Now, since I said it was semi-annual, basically that's split into two interest payments. So when you're looking at actually, it'd be $27.50 each payment, which is going to be two semi-annual payments. So every interest payment you get $27.50, but in a full year you get $55 of interest on this one. So you're earning a 5% yield on this one. Yeah, that's basically it when you look at the coupon rate. Now, what was I talking about when I said yield to maturity? That basically is going to also incorporate the price of the bond. Hello, doggy. Doggy wants to come in and talk as well. So the yield to maturity is going to incorporate the price as well. So if you're paying a premium for this bond, your yield to maturity will be a little bit lower because it's accounting for the fact that you're overpaying for this bond compare or relative to the par value. Now, something like a discount bond, and we'll get two examples here, you actually will have a yield that is higher than your coupon rate due to the fact that, again, you paid less than the par value, and you'll be getting the par value at maturity. So they incorporate that into this yield to maturity calculation, and basically it gives you kind of the true value in terms of a rate that you'll get over the lifetime of that bond. So look at the Citigroup one first, and we see obviously this coupon rate of 5.5. We see a premium, which means this yield to maturity here, listed right here, is a little bit lower than that 5.5, which means you're actually not going to earn that 5.5 when you account for the fact that you're losing money off of the purchase because you're only getting $1,000 back whenever that maturity comes. So something to consider there. And then we go down to a discount bond, the next one, right under it, 3.6% from Alibaba Group. You see it's a 3.6% coupon rate, but the yield to maturity is at 5.124, and that's because this one's trading at a pretty steep discount, 97.22. What impacts these prices? Well, for the most part, like I said, secondary market transactions is what makes this happen. But what makes the prices actually go up or down, right? So that's a question a lot of people have. What makes these prices fluctuate, for the most part, is going to be it's going to be interest rates. Let's just be clear with each other. So in a time like this in which interest rates are continually going up, companies are going to continue to issue new debt instruments that will be yielding higher rates. So basically what's going to happen here is as the Fed increase interest rates, companies will issue higher coupon rate debt instruments, and basically that means the old debt instruments that are out there, which are yielding much lower, are going to be a lot less desirable to investors. Therefore, the price goes down. So when interest rates go up, the prices of existing bonds go down, but the yields go up with them. So yields go up, the prices go down. Interest rates up, prices down. That's just the best way to think of it, and especially in a time like this, and we can see this in many cases. So we look at this. The Fed has just recently increased rates by 0.5 percentage points, and they haven't. I mean, Jerome Powell himself has said he's going to be pretty strong about this in the future too. In terms of Paul Davidson, is that Pete Davidson's brother? In terms of trying to curb inflation, as we see here, he's going to continue likely to raise interest rates. So in a time like that, you're going to see these existing bond prices probably tend to fall just because they're lower yields or lower coupon rates than a lot of these newer debt instruments are going to be. So really what's going to drive these prices in the secondary market is going to be interest rates. So as I mentioned before, interest rates going up, prices are going down. If interest rates fall, so in times in which interest rates fall, you're going to be seeing prices go up on the existing bonds because they're yielding a lot more. So those yields will stay the same, right? Your coupon rates will stay the same on the existing bonds, but the prices will go way up because they're going to be a lot more desirable. People want to lock in those higher interest rates. So they'll pay a premium for them. That's why those premiums go up. They'll pay a premium to lock in higher interest rate payments. They just want higher interest. That's the main thing there. So, and ideally here, when you see potentially an economic turnaround, you will see bond prices decline. And that basically, or I should say, you should see interest rates decline, which will mean bond prices will go up on these existing bonds, especially stuff like this, which the Citigroup one of 5.5. As yields, new coupon rates come out that are much lower than this. This Citigroup 5.5% bond is a lot more valuable, right? It's a lot more interesting and appealing to the public because they want that higher rate. So that's just kind of a basic of what's fluctuating those prices for the most part, and something to look at. The next piece of information that I really wanted to cover here was going to be your rating. So you see on the left here, left two columns, we've got the Moody's rating and S&P rating. And if you're curious what's going on here, we've got A, we've got A2, BAA. What are these A's and B's? What the crap does it mean? Well, just like you might think in similar to school, A's are better than B's. It's a similar premise to look at there. A's are better than B's. So I have a chart here basically to talk about these ratings. AAA is the highest investment grade out there. So that's going to be the S&P rating. Moody's does it as A and then two capital A and then two lowercase a's. A little bit different, but for the most part, we're talking about similar stuff here. So Moody's will have usually a 1, 2, 3, while S&P, the Standard & Poor's, will typically have a plus there. So we talk about these investment grade bonds, and this is going to be everything from triple B minus all the way up to triple A. Triple A being your highest quality ever, and it just goes descending from there. So once we reach these double B plus, these are going to be non-investment grade, or what we would call junk bonds. These are typically bonds that are going to be yielding a lot higher, and that's why they're considered junk bonds, because they're typically issued by companies with a lot less, I guess the best way you could say it is less reliable in terms of their debt coverage on a long-term basis. So I can search this up here too. Let me modify a search so I can represent these lower quality bonds as well, just so you can kind of see what those look like. So your high AAA ratings, you're looking at companies like Microsoft, and you know these companies, they're always very reliable. Obviously, they have a lot of money and cash on hands to cover that debt. But then when you get into these lower ratings, so let's take a look at a couple of these. So we have a couple of these like triple B minus, 6th Street Special. I mean, a lot of these companies aren't necessarily ones that you hear of massively every day. Or even you have Boeing, which is listed as a triple B minus, and that's because it's a company that historically has had issues in terms of defaulting on their debt. They've done it before. Companies like Ford as well. These companies have received bailouts from the government. Because of this, they receive lower ratings on their bonds. They're obviously a lot less reliable than a company that's AAA rating that hasn't had any issues with debt ever in their past. So basically, that's what ratings are, to cover that point of ratings. So we can go ahead and, oh yeah, we covered that. We covered that. Ratings, we covered. What makes bond prices change, we covered that too. So I kind of touched on this. When should you invest in bonds? Well, heck, like I mentioned earlier, when you're looking to get into bonds, so if you believe that interest rates are going to go down, let's say that's your opinion. You believe interest rates in the near to midterm future are going to go down. That's when you want to be invested in bonds. Why? It's because, like I mentioned before, the prices of those bonds are going to increase. So not only will the price of the bonds increase, you're going to lock in a better interest rate over the long term, as opposed to someone that's investing whenever the rates are going down already. They've missed out on those bonds that you bought potentially at a discount that are yielding higher. They're missing out on that because now they're going to have to pay a premium for that exact same bond because that bond price went up. So if you're going to look to be invested in bonds, you would buy long-term bonds with higher yields whenever you think interest rates are going to go down. Now, the same can be said for the other time. You really don't want to touch bonds as much, especially the long-term bonds. You don't want to touch them when you think interest rates are going to go up. So if you believe interest rates are going to continue to climb, you don't want to buy these long-term bonds because you're going to lock yourself into a cheap interest rate, and the bond price is going to continue to fall because it's going to be less desirable because it's offering such a low rate. So there's going to be nothing going well for you there. You're going to have the bond price fall. You're going to have the yield be a lot lower than a lot of the other yields out there. So that's kind of a generic answer of when you should invest in bonds. Now finally, we'll touch on inverted yield curve. It's definitely a scary topic a lot of people have heard. So, and you've probably seen this too. Get out of here, Investopedia nonsense. When you see this scary image, what in the world is this even talking about? So the brief way of saying this, because we've seen the inverted yield curve just very recently as well. This is a time in which your lower maturity bonds, your closest to maturity bonds, are yielding higher. So when does this happen? My apologies. Need some water, man. Gotta get some water. This traditionally happens in a time in which interest rates are climbing rapidly. So a lot of these companies won't want to lock in a lot of long-term debt at very high yields, because why would they? They don't want to pay out large interest payments over a long period of time, so they'll issue short-term debt in these bonds, short-term bonds typically, at higher yields. So that way they can reassure that they're going to get that financing and they don't have to do it over a long period of time. So the long-term bonds kind of stay stagnant. You're not going to see a lot of new issues at very high rates there, because the high rates are all in the short term. Companies don't want to pay giant yields over a long term. They never will. So typically when you see this inverted yield curve, it's most likely a sign of recession to come or a current recession, because of the fact that interest rates are climbing so high. And interest rates are typically a leading indicator in this sense, right, of what's going on in the economy. So when we see interest rates climbing rapidly, we got a bad sign, okay? The economy is looking a little bit rough, and that's when you get situations like this. So that's the inverted yield curve. Typically a bad sign when you're looking at the economic standpoint, and it could have impact on stocks as well, but we're talking about bonds here today, okay, folks? So what else do I really want to cover on bonds? My last little touching point, and it's all I'm going to add here, is going to be talking about call features on bonds. I know I didn't list it on there too, because you see a couple of these as well, where it'll say callable, or some of them will say not callable. So what does this mean? So callable just means that the company is able to call that bond back to you prior to maturity. So if a bond is callable, the company, if it wanted to, could take that bond directly back from you at the par value at any time. Once that, normally they'll have a call date listed. So let's just say you might ask, why in the world would a company call back debt early? Obviously they wanted that financing over the long term. So they would call back a bond, let's say, like we mentioned there, with a long-term bond that has a high yield. Let's say they did issue that. Those likely, it's not something they want long-term. So they would probably issue that with a call feature where they could call that bond back early whenever they felt like they needed to. So that way they don't have to lock in that long-term, high-yielding bond. So that way they're not paying that massive interest rate over a long term. So they put a call feature on that potentially. It makes it a little bit less marketable, obviously, because investors typically will want call protection. So that way, in case yields go down, they're going to want call protection so their bond doesn't get really bought up from under them. They want that yield. So typically that would mean the price will be a little bit, it won't trade at as much of a premium, typically because of that. That's something to consider. That is everything I have really in terms of bonds. This thing went long, so I hope you stayed around for it. Bond basics, dude. I hope you're excited. Let's talk about the money. I mean, look at that. Money, bonds, money. I'm in the money. That's what I'm talking about. That's the video. Hope you have a great day. 7.8.